This webinar is proudly brought to you by IG South Africa. Visit igmarkets.co.za to open your trading account today.
Welcome everybody. As Simon says, today we're going to just have a look at some Forex basics. I have covered some of the risks, just to show you the difference between various instruments. But let's just start out looking at what or how the Forex pair is made up. Forex trading is when you decide on one currency strengthening or weakening against another currency. It's when you decide on one currency strengthening or weakening against another currency. We trade Forex pairs, and those pairs are illustrated as follows. Underlying it would be 1 euro equals 1.36236 US dollars. On the platforms, and whenever you read about them, they are displayed as euro/USD 1.36236, and that would be the quoted price of that pair. The euro is known as the base currency, the first currency. There's always the base currency. And the second currency is known as the quote currency. So it will always be one base currency equals so many of the quote currencies. Today I've just used Forex mini pairs just to keep the numbers manageable. Once you start going to standard contract sizes, the numbers become quite scary on the one hand, or a little bit overpopular on the other hand. So we just start with the basics, keep it small. Euro dollar is trading at 1.36236. This pair is traded to the 5th decimal place, which is the 6 on the end there. As that number changes from 236 to 237, it is worth 10 US cents. In other words, that 5th decimal is worth 10 US cents. When the 4th decimal changes, it is worth $1. When the 3rd changes, worth $10, etc. Don't worry, we'll cover it in a little bit more detail as well. The value of the tick, which is the 5th decimal place, is determined by the quote currency. Here we have a look. So we've looked at euro dollar. We have a quick look at the US dollar, Canadian dollar. So USD CAD is 1.10256. Then 1 US dollar equals that in Canadian dollars. If the tick changes from 256 to 257, it is worth 10 Canadian cents. So when you look at your pairs, the second currency gives you the value of the tick, or the pips if you're using the 4th decimal place. So please remember that. So if you trade dollar yen, then that last tick is in yen. Okay, risk comparison. Look, I come across this probably every week. I want to trade Forex, I want to trade Forex, I want to trade Forex. And then you say to the person, what do you know about the risks of Forex? So what I tried here is, in South Africa, the Aussie is a very common and a very popular instrument. So I used that as our baseline. In other words, where do we start? The Aussie's minimum margin requirement, obviously this varies per stockbroker or per platform, but I'm just using the suffix number here, 24,000 Rand. That 24,000 Rand has a value of 410,000 Rand per contract. So I buy one Aussie contract, its value is 400,000 bucks. I then said, okay, fine, how do we measure risk without looking at money management and all that stuff? The simple way is to look at volatility. So I took an average true range over 2 days, just to get, average true range being the true range added together divided by 2. Average is around 500 points on the Aussie at the moment, and that would be a value of 5,000 Rand. So if you got the average return, you get 5,000 Rand. If you were wrong, you'd lose 5,000 Rand. I then took another popular share, Standard Bank, and I used the same margin requirement. Remember that the leverage and the gearing are different in all these instruments. The margin on Standard Bank took the same margin value, 24,000 Rand. On Standard Bank, it would equal 240,000 Rands worth of shares, so it's times 10. The true range, or the average true range over 2 days on Standard Bank, is 2.85 Rand per share. So if you got exactly that average, you would make or lose 5,893 Rand. Already that tells me or shows me that Standard Bank is actually slightly higher risk than the Aussie. If we just take the average volatility and we get the best price or the worst price of the day, Aussie's worth 5 grand, Standard Bank is worth 5,000, 900 Rand. When we take this to Forex, it changes the ball game a lot. We take the same margin requirement of 24,000 Rand. The value of that contract, or that number of contracts put together, is 1.749 million Rand, or $159,000. Then you just multiply that by 11. The true range over 2 days is 70 pips. Okay, so that's 70 points, not micro points, or 13,090 Rand. So it's more than double the Aussie. It's nearly 3 times the Aussie. Okay, and it's just over 2 times Standard Bank. That is where the risk of Forex comes in, is that we can take really, margin, 24 grand margin, and we can have massive exposure to the market. You get that wrong by 1%, and you're not going to be a happy person. On the Aussie doesn't move 1% in the day. Okay, Standard Bank can move 1% in the day. Currency, on the other hand, might not even move 1% in a week. Yet the amount of margin to exposure that you can put down is where the danger comes in. So if you are just starting out in Forex and you have traded other instruments before, that's the risk. You cannot take the same margin requirement into Forex and expect to get the same results. You have massively leveraged yourself up. Now, in Forex, for instance, you can in some places get as high as 400 times leverage. Yeah, that's just crazy if you think about it a little bit on the logical side. If you get it wrong, it's going to hurt you deeply. So what I did for today's presentation, I just brought it right down to the absolute minimum that we can trade. The Forex market is really people who know how to trade can really make money in Forex. So if it's something that if you have been trading other markets for 5, 6, 7 years, maybe even a bit longer, you know sort of what you're doing there, you're consistently profitable, you can go look at Forex and you can increase your leverage to increase your returns. But of course, you also increase in your risk. Forex can be traded as small as 1 Rand a pip. Okay, so we can trade, instead of $1 a point, we can trade a Rand a point now, and that would be on the 4th decimal place with terminal velocity. Or you can get offshore accounts that offer micro contracts. You can trade at 10 US cents per tick. So you can trade the tick if you find someone who offers you a micro contract, and that would be on the 5th decimal. This means you can trade with very small risk numbers as you learn the business, and when you have produced consistent profits, consistent being 6 months or more that you are profitable, preferably more than 30 trades, you can then increase your leverage accordingly. So the risk that everybody talks about in Forex is that most people trade way too large for their accounts. They're trading 1.5 million rands worth without even realizing it. Keep it small, learn to trade. It'll take you 2 to 3 years. Get those 30, 40 consistently profitable trades behind you. You will then know what you can do on the leverage side. You can increase it slowly but surely, 1 extra contract every couple of weeks, or give yourself a target on your capital. So every time you've made 25% on the account, you can then increase by 1 contract at a time. You can execute day trades as well as long-term trades in Forex. You can day trade currencies. That is not something I recommend. Most of the time, the volatility can really put you off. Currency, you can do nothing for hours and hours, and then all of a sudden, in 10 minutes, it's run 60 points, and you've totally missed it. You buy in the top of that move, it then starts to retrace. You stop out, only to see it a couple of hours later breaking higher. It's not a really easy place to start day trading. I prefer to look at it over the longer term. Each currency pair has its own personality. So if you trade euro, dollar, dollar CAD, Swiss franc, whatever it is that you look at, those charts they all look different. They all behave differently. They also behave at different times of the day. So if you trade Aussie dollar, New Zealand dollar, that's going to be most active hour really early morning. If you trade euro, US dollar, that will be a little bit active in the morning when Europe opens, and then again in the early evening, and then sort of after 7, 8 o'clock it drops off to nothing. So each pair has its personality and it has its best trading times, much like individual shares. The price action is driven by expectation of one country's economy compared to another country's economy. Yeah, that's when you trade a currency pair, you are actually taking a view on that country's economy versus the other country's economy, or even in the case of the euro and economic zone, you're taking the whole of that one versus the other and trying to make a decision. Um, there are many things to consider when we look at forex pairs. Interest rate differentials. Yeah, one country has a higher interest rate to another country. People are going to be moving their cash across to that country with the highest interest rate. And that will then obviously strengthen that particular currency, which means it will weaken against the currency that has the lower interest rates. One of the big problems we've had over the last 2 years in Forex, I don't teach a lot of Forex, simply the market hasn't been there to really trade like it should be. We've had this whole quantitative easing scenario after the big correction. But the other thing is this Reserve Bank intervention, where Reserve banks around the world get involved directly in the Forex market. They prop it up or they push it down, they try and manipulate it. What often happens then is the currency does nothing. You can go and have a look at some of the historical charts of the dollar Swiss franc. It spent months doing really virtually nothing. You just couldn't trade it. And a lot of the times that the reserve banks get involved, you can't actually see it. You'd have to be up to date on the news to know that they'd actually done it. You'd be wondering why the pair is not moving, then all of a sudden it takes off, and then it does nothing again for a while. So reserve bank intervention is difficult to see in the charts. The other thing, of course, is economic news. So the big one is the US employment figures, non-farm payrolls. The housing starts, new houses getting sold or getting bought. Those things affect the US dollar pairs. And by definition, that can spin off to other currency pairs that are not related to the dollar, just as money shifts from one economy to another. So we look at the rand weakness. The rand weakened, and the dollar strengthened. The dollar strengthened across the board, basically. The rand weakened across the board. If the American economy is improving, money is going to go back to America to invest in that improving economy. South Africa's economy is not looking that great, so they're not going to leave their rands here. They're going to export it into euros. They're going to export it into dollars. That weakens the rand. Until that stops, the rand will continue to weaken. The expectations of all these fundamentals is what actually drives the pair. It's not really the result itself. It's the expectation of what that news is going to do over the next 6 months or 12 months. A trending pair usually points to relative certainty of one economy strengthening over another. Whilst the swings, those pairs that are swinging rather than trending, are created by uncertainty in one or both of the countries. One of the most difficult pairs to trade now at the moment, longer term, is actually the euro dollar. We had the eurozone looking pretty dodgy. 1 month it's good, 1 month it's bad, but overall it's bad, and then suddenly it's good. And on the other side of the ocean, we had the Americans with the same scenario. It was looking good, looking bad, then the economy's turning. You've got this volatility, and if you look at the day chart, you would actually swear it's a 5-minute chart. So we're going to have a look at that as well. When trading currencies, it's easy to get weighed down by the fundamental considerations and forget about perception. There are way too many analysts out there looking at this stuff, taking a view on behalf of the banks and other funds. They're going to drive the currency. They're going to drive the pair. So we should know what this stuff means. We should know why employment figures, why unemployment figures important. But we should not be trading that news event. You should already be in that particular pair, or you should just stay out of it, unless, of course, you want to become a news trading specialist. That's probably the highest failure rate are traders trying to catch the news. That's where most traders fail on Forex. So I'd recommend you're either in the trade or you stay out when the news comes out. That perception will drive the shape of the chart. So just like a stock, when we look at Coronation, for instance, this is a share that just continuously goes up. It then had a small correction now with a little bit of uncertainty and quantitative easing and all that. Just come off a little bit into a beautiful bull flag. It's now broken that for 2 days running. That tells us that the market likes that company. Whether their PE ratio or their book is too high, too expensive, too cheap, doesn't seem to matter. Money keeps going in there. And the same thing with the currency pair. if the dollar is expected to continue to strengthen over the next 5 years, it will go into a trend. All right, so the trick is to find, again, trending pairs and find a way to enter those trends. Okay, know what the need means, but trying to catch these short-term moves, unless you're a full-time Forex trader, focused on the charts, that's all you do day in and day out. You part-time traders, yeah, rather look to build positions. I'm going to show you how to do that shortly. Well, one way to do it. All right, so the perception drives the market. A Forex chart looks like any other chart. Price is down the right-hand column. Just the price is slightly different, whereas, you know, as it's in proper decimals, 1 point and then 5. Some currencies like the yen, dollar yen is 2 decimals. The same principles that guide all other instruments guide Forex trading, but with subtle differences. Okay, in other words, indicators that work on shares work on Forex, but in totally different ways. That is why if you're a successful share CFD trader or maybe an index traders would understand Forex a little bit better, especially if you trade the Aussie, because it also doesn't follow the rules that well. But currencies definitely show up weaknesses in trading systems. So you do need to work a little bit to get your particular trading system working on currency. And very often we find things that work on everything else fail on Forex. All right, so here's a trend that started a long time ago. It's about 2 years now, the Aussie dollar, New Zealand dollar. I just use 21 and 89 exponential moving averages as a trend tool. As long as the 21 is below the 89, trend is down. If the 21 is above the 89, trend is up. But I also want to see a history of trend. When trends change, you don't see it until much later. In other words, sometimes you have to just put the trade on and see what happens, and you manage that with money management rules. Okay. Here we have the Aussie dollar, New Zealand dollar trending down, and we can see in the history of the chart, there's only 3 places where it has actually broken the 89. The first one is up here, the second time over there, and then the third time a little while back, price broke above the 89. Only 3 times in that, it's about 2.5 years here. That is it. The 21s remained below the 89 that whole time. That is a strongly downward trending currency pair. The other side of that coin, of course, is the longer the trend has been in place, the closer it could be to change. Currencies don't trend forever. So it might trend for 2, 3, sometimes even 5 years, but at some point it will turn as those 2 economies change direction. There's been a lot of criticism of the Australian government and the way that they're doing things and all the rest of it. So there's this perception out there that the Aussie dollar is weak. Their economy is weak. And the same perception says that New Zealand is slightly stronger. Basically, they're buying New Zealand dollars, selling Aussie dollars. Here's the euro dollar. This is more of a swinging type share. If you're any good at swing trading, you would probably love this chart. To me, it looks like sort of a, maybe a 10 or 15 minute chart. It's actually the daily. You can see that the averages have crossed over quite a few times. The first one back there, then we've got another crossover here, then another one over there, then another one, and then we've had just a few months of slight trend. Just because the averages are above doesn't mean it is a trend. We have to look at the swings as well. We can see that this pair is very choppy. It crosses the 89 moving average way too many times to be considered a strongly trending pair. So for me, that would leave it sort of high and dry. I wouldn't touch it. It's not a clear trend, and it becomes too difficult to do your money management. One of the things to notice is the failure points of support and resistance. Let's just use a basic one over here. We've got resistance. The market breaks above resistance. It then pulls, fails, breaks that resistance. It then goes down to long-term support and bounces up, comes through, tries to break resistance, pulls back, breaks resistance, goes higher, higher, bang. It pulls back and breaks that support that was resistance. This is a classic chart of something that is not trendy. That up and down through support and resistance, continuously false breaking, false breaking, false breaking, is normally a corrective chart. In other words, euro dollar might be strengthening, but it looks corrective. In other words, I would expect eventually for the dollar to strengthen again, the euro to weaken, and this chart to start falling off, and hopefully give us a decent trend. Years gone by, let's say 5 years ago, it was a beautifully trending pair, and it was rather simple to trade. Now, I hardly look at it for trading purposes. Trending pairs are simpler to trade, longer term, and do not require permanent watching. There are plenty of people out there that want to come home from work in the afternoon and sit down in front of their charts at 5 o'clock and try and make 2 or 3 currency trades before having dinner. Yeah, that's a recipe for disaster. Okay. What you want to do at 5 o'clock in the afternoon is check for long-term trend. Is there a trigger? Can I buy something now that I only have to look at in 3 or 4 days' time? This is probably one of the very few times that I'm happy to put my stops in a platform. You know, to put the stops in the market and leave it. Day trading can be done on any pair. So, you know, I could only cover so much in a 30-minute session. I didn't cover day trading. It can be done on any pair as long as you understand that pair's personality and you have a decent system. Now remember, a decent system incorporates everything from your trading styles, your money management, a proper trading system. Then you can go look at day trading, and you must have time. Please don't think that you can work a day job and then quickly trade 2 hours in the afternoon. You've had a long day at work, you're tired, you're probably hungry, you're going to mess up and you're going to lose that account. All right, a simple trending system. When the 21 crosses the 89 on a trending pair, the first trade is entered. The stop is placed above or below, depending if it's an up or down trend, the previous swing high or low. Straightforward, we'll see it on the chart shortly. If the price crosses the 89 again, in the same direction as the initial trade. So on the trade I'm going to show you is a short. The 21 crossed below the 89. It went down for a couple of months. It pulled back, price crossed above the 89. Price then moved back below the 89 without the trend changing. In other words, the 21 remained below the 89. That second cross down through the 89 can be another trade or another entry, so a second position is executed. The stop is then trailed to the previous swing high again. So as the market moves up and down, it requires a lot of patience. As it moves up and down and it gives you those swings, you just lower your stop to those next highs. If you miss the first crossover, in other words, the first time the 21 crosses the 89, you can use the add rule to apply as a first entry. This is certainly not about building $30 million trades. We'll see in the example. Just using 1 Rand per pip to show you how this works. 21 cross below the 89, you sell 1 Aussie dollar, New Zealand dollar. The entry value is 1.27645. The stop loss was the previous swing high at 3,400, so 270 to 280 pips, or in this case it would be 276 Rand. Not on the tick, so I work on the pips, I work on the 4th decimal place. Target is unknown. It's a trending system. The swing high above the 89 EMA is a trailing stop. I'll illustrate that for you. 1.28307 is the next high above the 89. The stop is trailed. The second entry is at 1.26000. The support line is broken, and the price moved below the 89 again. The stop remains at 28307. The first entry now has a 66-point stop loss, so it would be a loss of 66 pips. Entry 2 has a 230 pip stop, so total on those two contracts 296 pips, so let's say 300 Rand. Okay, instead of numbers, pictures always work better. Basically, entry 1 happens here. The 21 crosses below the 89, entries in one of those candles. The stop loss is the previous swing high, which I just put at about 13500 over here. The market moves off. Now this is where traders get a little bit nervous. We have fantastic trade. It moves off a good couple hundred pips, and then it starts to retrace, and it does the usual ABC, A, B, and C. So it moves back in 3 steps. The 21 average never crossed the 89. Never crossed up there. The market continues down, it then breaks support and the 89, so price breaks the 89, plus it's breaking below support. The next entry is instituted there on that little yeah, it looks like a doji hammer thing. That's the second entry short. The stop loss on both contracts is the previous swing high. And again, the market comes down, it pulls back, it breaks the 89, breaks below the 89. This is not a trade. That price there is actually worse than your second entry price. In other words, you're actually getting ready to stop out. So you're not going to be adding a third contract when you're this close to a stop loss area. You always want to add at a lower price on the shorts. In other words, you're buying into momentum. So this one wasn't a trade. Market again moves off nicely, a good couple of hundred pips. You're smiling. It then pulls back again. We can see the bull flag pulling through. There's a bit of a measured move happened here. The market then goes sideways a few days, comes down, bounces on the 89, bounces on the 89, 3 days running, breaks below the 89. There's the third entry. Stop loss for all three contracts has moved to the swing high at 12700. So we've got three trades and quite a bit of nerves when it comes from these lows, pulls back up, lows, pulls back up, and that's where a lot of traders get stopped out. If you do stop out, you can always enter again. You don't have to hold it. You have 5, 6, 7, 8 contracts if you're lucky you get that many trades. You don't have to hold it all the way. You can measure a target point and then wait for the next signal. Obviously, you can do anything you want in the market that makes you profits. Third, fourth, and fifth entries are depicted here again with the yellow arrows. That's the last one we looked at. Again, same thing happens. Market pulls back, breaks 89. Averages don't cross over. Market pulls off again. Didn't break the previous stop high. Swing high, stop loss. Breaks down, shorted again. Now you're up a couple of hundred points. It pulls back, hits the 89. This was a head and shoulders trade. There's a nice, beautiful head and shoulders over there. Neckline breaks. Touched the 89. Good enough for me with the chart pattern. You could enter the fourth trade. The fifth trade can be argued that if you didn't enter the fourth one, you could have entered the fifth one. If you had entered the fourth one, the fifth one would have been left alone because the prices are actually worse off. So the answer would lie with you. This is the trade that I took. I didn't take number 5. So third entry, I don't want to go too much on the numbers. It gets a bit confusing. Basically, you saw the third entry on the chart. Price crosses below the 89. Enter the trade. Stop trail to the previous swing high. Fourth entry is a head and shoulders with the head hitting the 89 EMA as resistance. Obviously, that trade was only taken once the head and shoulders neckline was broken. The stop is trailed to the top of the head. Entry 5 is invalid. Entry price is worse than entry 4. If you had not taken entry 4, you could have instituted trade number 5. The stop is then trailed to 15810. Current position of what we just looked at. So we have 4 active trades. Current price is 1.08452. Current stop loss is 9461. Entry 1 is up 1,920 points. Entry 2, 1,750. Entry 3 is up 1,620 pips. Entry 4 is up 500 pips. Total so far is 5,800. With the stop loss 100 pips above the current price. So it's very close to actually stopping this lot out. Profit would, which means 400 pips would be taken on the stop loss. You've got 4 contracts. One is 100 points. So profit would be 5,400 pips. Remember, again, that's on the 4th decimal point, not the 5th. Simple, not easy. It is a reasonably simple strategy. There's nothing complicated about it. There's no Fibonacci's. There's no, not too much going on. It's simple in hindsight to ride a trend this way, but it's not easy to implement as the market moves in big swings during the trend, and you have to hold while your max profit is drawn down. So you get to this maximum, let's say 500 per profit. The market then pulls back and you lose 350 of those. You got to hold. It will take you more than one attempt at it. You probably have 20 or 30 attempts over the next 5 years to catch these trends. Some people never get it, that they can get the whole trend. And you know what? That's fine. As any of you that have listened to previous webinars I've done, the trend is your friend. Anything in the direction of the trend should pay off on a probability basis. Doesn't mean you'll always be massively profitable, but most of the time, you'll get a decent probability. And then you have to add to this position when the trend reasserts itself. So we get the drawdown, then the trend reasserts itself, and now you've got to add a second trade. And again, it comes down to money management. How big is your account as to how many times you can add to the trade and how many contracts. Okay, so keep your position to an appropriate size where the stop level is less than 1% of account capital. Forex is highly leveraged. You do not need to risk more than 1%. It is not a share. It's not a share CFD where you've got to give it this much space. A share can easily have a 5% on the underlying as a stop. Okay, so you can risk 2 to 3% of capital. On Forex, you do not need to risk more than 1% of your account capital. All right, guys, thank you very much for listening. I hope that was informative. Those are my contact details. You're welcome to send me any questions if you have them, other than what's coming up now, Simon.
Thanks, Warren. I like it. Really concise, to the point. The only question we got so far, guys, and girls, if you've got questions, put them in the Q&A box. And the question is, so we shouldn't start with FX trading. And I concur 100%, Warren. You made that point loud and clear. FX is dangerous. There's money to be made. But man, if you're not a pro here, there's a huge amount to be lost. I remember my brief foray. I was trading dollar, yen. Bank of Japan came in at about 3 o'clock one morning, our time, to move the currency and just obliterated my account in the process. Absolutely obliterated it.
Yeah. Look, I think let's look at this from two perspectives. If I've got 100,000 Rand, I wouldn't pump that into a Forex account. I'd rather go learn to trade some shares and look at the Aussie after 2 years of trading share CFDs or something. If I had a 10,000 Rand account, and that's all I had, and I just wanted to learn to trade, in Forex we can do that with very little risk at the 1 Rand a point, at 1 Rand a pip. So even if it goes 500 pips against you, it's 500 Rand. It's not the end of the world. The risk with Forex is guys go with 10 grand and they bet 9 grand on a trade.
Yeah.
And they wipe out that account in 5 minutes. Okay, so the idea is if you do start with Forex, it's going to take you 5 to 6 years to actually learn to make money there. It's not a simple market to learn. I trade 14 standard pairs. 14 pairs that I look at all the time. But there's, what is it? I think there's about 40 odd of these things that you can go and have a look at, exotics and all this massive costs and big spread and so on. If you get those right, good money, but most guys are going to get it wrong. So start out small, go look for the things that are in a strong trend, and go and use a little bit of money, not big leverage, trade one little small contract at a time, and you're going to be better off than trying to, for instance, take your first foray into the Aussie. The Aussie is 10 Rand a point, lose 500 points on average in a day at the moment. That's 5,000 Rand. So you don't want to trade there. If you go to the All-Me, it's also 500 Rand. So it's Forex 500 Rand, but Forex doesn't move 500 points. The Forex will move maybe 70, 80 pips in a day, on average I'm talking about. To get a 100 pip move in Forex will normally, if you take you a day or two, take you 2 days or 3 days even sometimes.
Yeah, I concur with that. I mean,
all these more volatile, but Forex is more highly leveraged.
Yeah,
that's the difference.
I say to folks, go and start with some Ormies, trade some space there. Jan, you're asking what are the FX pairs, and someone else was asking how many. There are literally hundreds and hundreds, majors and minors. But Warren, the question is, are there any other FX pairs at the top of your mind that trend in the same sort of way that the example you gave there? You said euro dollar is not a good one. You looked at was it Aus dollar, New Zealand dollar, like that. Any others?
Not as nice as the Aussie at the moment.
There we go.
This is the problem I'm having with Forex.
Yeah.
I don't have trades on. I just look at those charts and what happened? Aussie dollar, New Zealand dollar was a very simple trade. It topped out. So there was a bit of a chart pattern at the top there. It broke that support. The averages crossed over. I could get my first trade. By the time the trend kicked in, it was already past what I would have done with just the EMA.
Yeah.
If you know what I mean.
Yeah.
When you look at the other pairs, nothing stands out off the top of my mind, I'm not in any other trades. Yeah, look at those currencies and they're choppy, man. It's been difficult with the QE. But that's just me. Obviously, there's guys out there that have traded and made good money out of it.
Yeah, and a bunch who've traded and lost money. Alan, you're asking about safe platforms. I'll give my 5 cents. I mean, Velocity, which Warren talks about, IG obviously have got offer currencies as well. I suppose the point is that just because they have a big advert on some TV station doesn't make them safe. If you don't know the company, walk away, do the homework. If you just simply Google a lot of these platforms, you'll find a lot of currency forums where they'll talk about them. If there's problems, the biggest issue is getting your money out in some cases, or literally one morning they disappear. And I know of more than one example of that.
Yeah, please, guys, stick to the, I know we say big names are no safer than any other company. A big company is just as probable that it fails at some point. But there are big name Forex companies out there. Simon mentioned a couple now. You've also got FXCM in the UK.
Mm-hmm.
Those are businesses that have been around for more than 2 months. So they're the ones you want to look at. These little shops that operate some, from, I don't know if I can say it, Simon.
No.
The Eastern European.
Say away. I don't mind.
There's some really dodgy platforms out there. Please, guys, look for the big names. Currencies are not expensive to trade. So even if you are paying 1.5 pips, that's not a lot of money for a little bit of security. Most of the big guys have decent spreads. So they are reasonably cheap to trade. Okay,
yeah.
But these small little places that you've never heard of, Belarus and that kind of thing.
Yeah, and you might save a little bit on the spread, but if there's so many other risks, and it's the same in the market here. You wouldn't go and do your stockbroking at Simon's and Warren's famous stockbroking business, and we operate out of the Radium Beer Hall. Don't get me wrong, Radium Beer Hall is the best pub in Joburg, but you would go to a stockbroker who you think, hang on a second, do your diligence, do your Googling, do your digging, and if you can't find information, if you haven't heard of them, move on. There are hundreds and hundreds of them, but we threw a few names out there. Ladies and gents, we will leave it there. Time is working against us. Ben, appreciate. Warren, really, thank you very much for your time. A great presentation. Ladies and gents, thanks very much for your time. Cheers all.
Thank you, Simon. Cheers, everyone.
This webinar was proudly brought to you by IG South Africa. Visit igmarkets.co.za to open your trading account today.